Okay, let's unpack this. Welcome to the deep dive. We're starting 2026 by taking a look at the stack of sources you provided. And, I mean, the financial snapshot from the New Year's turn is just screaming conflicting signals at us.
It's a classic situation, really. You have a low-volume holiday thin market, but underneath all that, the plumbing is under some very real stress, and fund flows show total disagreement.
So our mission today is pretty simple.
It is. We need to understand the weird state of liquidity management right now, dissect the extreme thematic divergence we're seeing, this kind of market schizophrenia growth stocks versus deep defense.
And then put together a strategy that makes sense of all this tension for you.
Exactly.
That divergence is really the thread running through everything, isn't it? But we have to start where the money physically moves. The central bank's liquidity tools, the immediate concern is this year-end liquidity crunch combined with, well, stubbornly high rates. We saw some really unusual action on December 31st.
We did, and this is where the market tension, it really shows its hand. What's fascinating here is the sign of this seasonal, short-term liquidity stress that just spiked right at the calendar turn. And it's all in two big counteracting data points.
Counteracting how?
Well, the numbers show the institutions were simultaneously desperate for cash and parking excess cash. It makes no sense on the surface.
Okay, so give us the specifics. Let's start with the institutional borrowing.
Right. The New York Fed's Standing Repo Facility, or SRF, this is where eligible institutions can go to borrow cash quickly against collateral.
The emergency tap.
Basically. And it saw a record borrowing of approximately $74.6 billion. That signals a really immediate demand for short-term funds.
$74.6 billion. So that's institutions screaming for cash. What was the flip side then? Where was the excess cash being parked?
At the exact same time, the overnight reverse repo facility, the RN and RRP, which is where institutions park huge amounts of cash with the Fed overnight, it saw an inflow of about $106 billion.
I have to stop you there because that is the most contradictory signal you could possibly get. If money is that tight, why are institutions simultaneously using the Fed as a vault for over $100 billion? What does this stress really tell us?
It reveals underlying regulatory and seasonal pressures more than a complete system failure. But the tension is definitely real. Think of it this way. At year-end, banks have to meet specific regulatory requirements.
Right, for their balance sheets.
Exactly. Balance sheet size, liquidity ratios. Some big institutions are trying to shrink their balance sheet for regulatory window dressing. That forces them to push cash out, and that cash ends up in the RRP.
Okay.
Meanwhile, other institutions, maybe regional banks or primary dealers, they need specific funds to cover immediate gaps or settle big transactions before the year closes. So they hit the SRF.
So it's not that the entire system is cash poor, it's that the cash is just in the wrong places at the wrong time because of these deadlines.
Precisely. Short-term liquidity remains a key focus for the market because while the Fed managed it, the high use of both tools confirms the plumbing isn't running smoothly. This usually fades in January, but that underlying sensitivity, it's a risk.
All right, moving from that very short-term stress to the longer anchor for the market, interest rates. The U.S. 10-year Treasury is still sitting up there at approximately 4.16%. That's a high cost for long-term money.
That 4.16% figure is a critical anchor. It represents a real cost of capital. And investors are still trying to price in rate cut probabilities for 2026. But the timing is, well, it's highly uncertain.
The market's betting on cuts, but the data isn't really cooperating.
Not at all. Inflation has definitely fallen from its peak, but it's what we call sticky. Our core indicators are just hovering uncomfortably near the Fed's midpoint tolerance.
And on the growth side?
Employment is surprisingly resilient. We've seen no signs of severe deterioration in non-farm payrolls or unemployment. The economy is managing this controlled slowdown, which is great for workers, but it gives the Fed very little reason to rush those 2026 rate cuts.
Okay, let's connect that high, sticky rate environment to the asset markets, because this is where the narrative fractures completely. The high cost of capital should make investors cautious, right?
It should, especially about long-duration, high-growth stocks.
Yet, funds are flowing distinctly into two opposing camps. It really is thematic schizophrenia.
Absolutely. The money is flowing into aggressive growth and tech stocks and into deep defensive safe havens like gold and silver. This requires a completely bifurcated strategy. The market is pricing in boundless innovation and, at the same time, high-risk inflation.
So let's start with the optimism. What did the broad indices look like on December 31st?
The broad market strength is still very top-heavy. VOO, which tracks the S&P 500, closed around $628. But more importantly, QQQM, the Nasdaq Q100 ETF, closed around $253.
Which confirms what?
It confirms performance is being driven almost entirely by the big weights in technology and AI infrastructure.
And when we drill down to the AI leaders themselves, the valuations are just enormous. Why are funds still so convinced by these names in a high-rate world?
The conviction is driven by the realization that AI infrastructure is the new essential utility. And the names we're tracking are basically monopolies or duopolies in their specific layers.
Give us the numbers.
NVIDIA was trading around 186.50 to 187. Meta Platforms, Meta was near 660. And Alphabet, GOG, was approximately 313. The market is willing to pay that premium because these companies have a clear path to massive revenue scaling. And crucially, they're self-funding. They don't need cheap debt.
That makes sense. They're pricing in future dominance. But if the economy is this resilient and growth is so promising, why are investors simultaneously pouring money into physical gold? I mean, that's a classic fear trade.
And that's the tension. This capital flow into precious metals suggests a big part of the market either doesn't trust the Fed's inflation forecast or it sees systemic risk lurking under the surface.
What were the numbers on gold?
Spot gold was trading at an extraordinary range of 43.26 to 43.77 per ounce, a historic level. It reflects intense hedging demand. Silver was also strong, priced between 72 and 75 an ounce.
So investors aren't just buying growth, they're actively hedging.
They're hedging against persistent inflation and maybe instability that the employment numbers just aren't capturing.
And there's a key ratio here, right? Something that points to gold's defensive strength, even against Bitcoin.
Yes, the Bitcoin to gold ratio. It has significantly declined compared to its mid-year highs. This is a subtle but powerful indicator. It shows a rotation out of digital gold, Bitcoin, and into physical gold.
So when investors get genuinely scared,
they favor hard, tangible assets. It strengthens the gold narrative significantly, even while crypto prices themselves remain high.
Okay, let's shift focus to that world then. The asset class defined by volatility and sentiment. Crypto and high-risk secondary assets. First, a signal check on the market's general fear level.
We check the VIX, the fear index. As of the December 30th sample, VIX was approximately 14.3. This is quite low, near yearly lows.
And the implication of that is?
It's crucial for your strategy. A low VIX means that protection, specifically downside option protection, is relatively cheap right now. It suggests complacency, which carries a definite upside risk if any surprise news hits this thin market.
So, cheap insurance for those growth names. Now let's go to crypto. The pricing is high, but the sentiment seems to be telling a totally different story.
It is. The Crypto Fear and Greed Index is firmly in the fear zone. The sample value was around 30. This suggests that despite impressive prices, the retail and less leveraged institutional market is, approaching the space with a lot of caution.
And that caution creates volatility.
Exactly. Rising volatility because of thin holiday liquidity combined with that cautious sentiment.
What were the key levels for the top assets on January 1st?
Bitcoin, BTC, was consolidating after its year-end pullback. It was trading around 87.6K to 87.9K, holding strong ground. Ethereum, ETH, was around 2970 to 2980, and Solana, SOL, was priced between 124 and 126.
So they're holding up, but that fear signal means what? Stop losses.
Stop losses are critical. Absolutely critical.
Now, speaking of critical shifts, Coinbase is making a huge play, expanding into prediction market infrastructure. What does that strategy tell us?
It's a massive signal of diversification and regulatory maneuvering. Coinbase is accelerating its everything exchange strategy. This move into prediction markets with the clearing company lets an established player like Coinbase move beyond simple spot trading.
And capture a whole new revenue stream.
Right. It signals that these big exchanges are looking to become broader financial infrastructure, blending finance and information.
Okay, finally, let's touch upon the highest risk, least transparent part of this market, pre-stocks, the secondary market for private tech giants.
These are highly active, but carry extreme liquidity and regulatory risk. And the platform quotes can differ wildly. They're for the most speculative capital only.
What are some of the quotes?
For example, Anthropic pre-stocks were sampled around 320. XAI was traded between 95 and 100. And the dominant player, OpenAI pre-stocks, was quoted between 1120 and 1140. It's a direct play on AI, but the lack of transparency means you have to be extremely cautious.
We've covered the central bank stress, the high cost of money, and this wild split between AI and gold. So what does this all mean for how you should be positioned in 2026? What's the core strategy?
Given the low liquidity and the strong contradictory signals, the overriding takeaway is a defense-first strategy combined with phased entry. You have to maintain exposure to the growth theme, but you need significant protection against the fears driving gold to record highs.
Okay, let's break that down. The core growth component. Why is phase entry so necessary for names like NVDA and Meta when the market seems to love them?
Phased entry is essential because the valuations are already so stretched. When you buy NVDA or GOG at these levels, you're highly exposed to any disappointing data point. By phasing in, you average down your cost basis and you mitigate the risk of buying the absolute top.
And you mentioned protection.
Crucially, given the VIX is low, around 14.3, you should use that inexpensive option protection buying puts to defend the downside. It's cheap insurance.
That covers the optimism hedge. What about the fear trade? How do we incorporate gold and silver?
You have to maintain a hedging position. I wouldn't advise maximum leverage given gold's run, but a small cap position in a gold ETF or physical assets is wise. It's your insurance policy. If those systemic risks, inflation, debt actually materialize, this hedge will preserve capital when your growth stocks pull back.
And for crypto, given that fear index of 30.
The consolidation in BTC and ETH is at elevated levels, so this requires meticulous management. We strongly advise small phased entry points, but this is non-negotiable. You have to use strict stop losses. Flash crashes are common in a market like this, and pre-stocks, well, they're only for the smallest, highly speculative allocations you're willing to lose completely.
Finally, tying back to the macro picture, how do we position cash and bonds against that 4.16% 10-year rate?
You need to maximize optionality. Since the market is trying to price in rate cuts for 2026, you have to manage your duration risk. That means favoring short-term treasuries or just maintaining a healthy cash position.
And what does that achieve?
Two things. First, it minimizes your exposure to losses if rates unexpectedly move higher. Second, and more importantly, it positions you with ready capital, with dry powder, to capture buying opportunities if and when those 2026 rate cuts finally happen.
That was a complete breakdown of a remarkably tense transition into the new year. We started with that strange, short-term liquidity stress and the central bank's plumbing, and ended with a strategy to manage the huge divergence between AI growth and defensive precious metals.
It's a market defined by contradiction. The optimists and the pessimists are both being rewarded simultaneously, at least for now.
And that leads us to the final provocative thought for you to carry forward from this deep dive. The high usage of those central bank tools, the SRF and RRP, it suggests the financial plumbing isn't nearly as smooth as policymakers would hope. Given that the US 10-year rate is still over 4%, indicating expensive money, the critical question for you to consider is this. Does the sheer volume of stress we saw in that seasonal spike expose enough weakness to force the Fed's hand, potentially overriding the strong employment data and accelerating the 2026 rate cuts? Or does the stress simply confirm that high rates are here to stay, forcing the entire market to adjust to expensive capital for the poor?